Discuss the implications. We've got Earl Davis, head of fixed income and money markets at BMO Global Management. We've also got Frances Horodelski, former anchor at BNN Bloomberg. Earl, I'll start with you. There definitely was a sense this could happen, and it really wasn't a question of if, but when. We got it at this meeting. What's your initial read?
That's exactly it. You know, as hawkish as I've been, still continue, I was not expecting a hike today, and here's the reason why. When the Bank of Canada starts hiking, it's not just one hike. It is multiple hikes. And the reason why, if they thought they were only one hike away from being in restrictive, they wouldn't even go. They would let the lag effect of monetary policy kick in. So because they hiked today, I do expect to see one, if not two more, coming down the line before they pause again.
Where does this end? I recall the number 6% when we were talking to you in January, and you sounded crazy. And no, you didn't sound crazy. I thought you were crazy. But to be honest, I also hoped that you were wrong. And it looks like increasingly likely. Is 6% where you're going with this?
Yeah, I think where the crazy came from, I called 6% last June for this year on BNN, yes. And that's where I think the crazy came from. No, I think right now my base case is 5.25 by the end of the year, plus or minus 25 basis points. So that's a range of 5% to 5.50 overnight rates in Canada. I do think we see 6% in the U.S., though.
Frances, this is a bank that loves to surprise investors. Mm-hmm. Now, 6 of the last 12 decisions have been against consensus.
So I was in the wait till July camp for a couple of reasons, but I'll also say that maybe the Reserve Bank of Australia gave the Bank of Canada cover. They surprised on Tuesday, whatever Tuesday was in Australia a couple of days ago. Yep. And they... Despite the fact that in Australia, the economy is rolling over, and I'd say big time, wages are not. And I guess I was thinking that they would wait to get more evidence, especially on the inflationary front, because we have May, June, and July inflationary data yet to come. And it's against really, really hot numbers in 2022. I mean, they were really hot. Those were the peak numbers. Inflation has rolled over. So I'm not sure why they had to go, other than Mr. Macklem does seem to want to surprise. And we're seeing that in two-year yields. We're seeing that in CAD. So why do they need to go right now?
I actually think it's an easy answer. Inflation expectations. Core inflation, which has remained sticky above 5%, reflects inflation expectations. Anecdotally, talking to friends, now they're expecting higher inflation as well. And what that gets is, you know, more and more advanced buying, which just keeps it going. It's a vicious cycle of inflation. So what I think the hike today is, it's a shot over the crowd of inflation by a water cannon. Let them know the credibility's still there and whatnot. If they go again, which I anticipate they will, it's shooting into the crowd of inflation because they need to drop the expectations part of it down now.
And does a quarter point rise actually do that? I mean, you're saying there's going to be more.
Exactly.
But does it do that? I mean, does that make you stop and not go out to dinner tonight, not go and buy a barbecue next weekend? I mean, does that change the dynamics?
Well, I'm not saying 2023 is 2022. But the rate hike cycle started with quarter point rise of 50 in quarters, and it added up to 400 in the end to try to get it lower where we are now.
You might not change your decision to buy a barbecue, but you might change your decision to buy a house. And that is a big change as well from the last statement to this statement. In the last statement, the Bank of Canada says housing market activity remains subdued. I don't think that's how you would characterize housing market activity now. It just in one sentence says in today's statement, housing market activity has picked up. I think that might be an understatement considering we're sort of back to bidding wars. But does this effectively blunt that? When they say Canada's more sensitive to rises in interest rates, this is kind of what they're talking about.
It actually does the opposite in the immediate term. And the reason why is when people go and get a mortgage rate from a bank, they're usually guaranteed that mortgage rate for 3 months, 90 days. With the bank hike increase now, they know if they don't buy a house now, the next time they go apply for a mortgage rate, it's going to be higher. So I think you're going to get an acceleration of housing purchases over the next couple of months while that rate is still locked in. And then you'll have the impact that you're speaking to in regards to the financing cost of mortgages.
Another question on housing, though, is that rates are one factor. Immigration and lack of supply are probably bigger factors. So the Bank of Canada can't do anything about that.
You know what? You're right. What they could hope to do, though, this is how it impacts inflation. People's mortgage rates, as they renew, will go higher. Not rates, the rates will go higher, but the payments will go higher. That takes away from their disposable income. That takes away from excess demand. That's how the mechanism works, and that's what comes into the delayed impact of monetary policy.
I'm glad you brought up their payments increasing, because for a lot of Canadians that hasn't happened. Just the mortgages have been extended, the life of the mortgages. Do people run out of runway to do that as they have to fully renew their mortgages? Is that kind of a stopgap measure?
Well, I actually don't think the variable mortgages are the issue anymore, because we've seen the 450 basis points of hikes in the past year, and that's where the variable mortgage is. What's going to happen now is the renewal rates. You know, the people who got their mortgages 2021, 2020, they're all renewing between now and 2026, and their 5-year fixed rate's going to be much higher then, and that's what it's going to impact on the mortgage side of things.
The Bank of Canada also has used it, Frances, that the labor market remains tight. Higher immigration and participation rates are expanding the supply of workers, but new workers have been hired quickly. It just seems like the Bank of Canada is sort of this blunt tool that will cool things, but doesn't actually address the root of a lot of problems, which is we do have a lot of immigration and a lack of housing supply. Rates are not really going to change what that means for the economy, but it's all we have.
You're fully right. Right now, they're just focused on excess demand. That's all they could be focused on. The two areas we touched upon, service inflation, and you actually brought up the other area in Australia, wage inflation. We still have the same thing here in regards to wage inflation. So what they're trying to do is exact same thing: raise up the cost of financing new businesses, new companies, just so that they don't need as many employees, because it's that imbalance that's getting wage inflation up, and that's what they're trying to fight against.
And just on, so blunt instrument, the other instrument they're using is quantitative tightening. That's happening in Canada. We think about it more in the U.S., but it is happening here. What are because I'm not sure if they mentioned in the statement, but that is ongoing. So
they do, yeah.
Why
that it complements the restrictive.
It complements. Why can't they just continue to do that? Is it not enough?
Because what quantitative tightening is, it's basically the bonds that the Bank of Canada owns. When they mature, they're not buying new bonds. Yeah. So the reason why they can't continue, they already have a schedule to get that holdings of bonds down. It's not like they're going to sell what they can't have afterwards. So that's the reason why. It's a gradual, natural quantitative tightening, a complementary tool, as was mentioned.
But it's not an economic tool per se.
Well, the issue, and the central bankers, both in Canada and U.S., have brought this up. It's so new, they don't know what the impact on it will be, right?
Everything seems so
exactly.
New to
Monetary
me.
policy, they understand.
After years of negative rates, zero rates, whatever at all, they are walking in a world that they made and now have to figure out how to play with this new world, or within this new world.
It's actually not a new world. We're in the world of the 70s and 80s, and that's why it's a reversion to the playbook of the 70s and 80s. A lot of the market participants, and that's why we saw a divergence in market pricing and what the central banks were saying, are playing by the playbook of the past 10, 20, 30 years when inflation has been declining.